This has been, kind of foreshadowed by the Federal Reserve Vice Chair for Supervision. This is really tough stuff.
It's tough stuff, but as you say, it was telegraphed, most of it by Michael Barr, the Vice Chair for Banking Supervision. And as you can see, bank stocks didn't move that much in response. The KBW Bank Index was down 1.2%, but it was a risk-off session anyway. The S&P was down itself about 0.7%. But we did get the details, 1,000 pages worth of details, Kathleen, including the 19% capital boost that's mandated now. And for even smaller banks, so banks with about $100 billion in assets, that's going to be 16%. So banks were expecting it, but it's still now put in black and white. Not just that, but to make banks bear the responsibility for their own risk-taking, the regulators also want banks to start to use two different methodologies when they're calculating their risk-taking, and then pick the one that results in a higher level of risk-weighted assets. Banks won't love that because, of course, it'll mean a little bit more stringency when it comes to that. Michael Barr's message: this will better align capital requirements with risk. Banks say, well, yes, but it might make us less competitive, especially against some of our European aligned competitors, the likes of Apollo, the likes of Blackstone, hedge funds, and so on.
Bonnie, how much pressure will these proposals put on banks, assuming no changes?
Well, banks have time to respond, and you know that they're going to say this is going to put a huge amount of pressure on us. You know they're going to say it's going to crimp our ability to have share buybacks, it's going to crimp our ability to release dividends and so on. But just to put it into context, Heidi, banks from 2020 to 2022 raised about $137 billion in share buybacks. So when you think of that, it's $137 billion. The cushion that they've built up for this since the great financial crisis is about $121 billion. It's not even close to what they've given out already in the last 2 years. So banks can raise this fairly quickly. Moreover, there is a 3-year transition period. The whole thing doesn't start till 2025. And the FDIC chair, Martin Brunenberg, says that with the exception of just 5 banks, the others have enough capital already to meet the proposed mandates, and those 5 could raise the capital fairly quickly. So if banks complain that, they don't have enough in cushion, it's not going to go over with regulators as a really big complaint.